Hey guys, Tim Melvin here, and welcome to the update for September 22nd, 2023. Let me just pull the microphone over here, make sure everything's good. Let's just get kicked off here, folks. I just want to touch on something. Some of you might like my comments on this, some of you won't. Okay. The Federal Stability Oversight Committee and some other regulators are meeting this week behind closed doors. There's a phrase that when you put that in front of government always concerns me just a little bit. What they're talking about doing is expanding the definition of too big to fail. They're going to take this from just banks. And last time they included a couple of major insurance companies like Prudential, Metropolitan, the great big ones that dominate the business. And they were also designated as systemically important financial institutions. Too big to fail. Where literally the government can't let these fail or it has horrible implications for the rest of the economy. Now, they're talking about expanding this to include other financial institutions. For now, that's part of the part that concerns me. But we're talking they're going to bring in more insurance companies, more asset managers, even some hedge funds and other private investment funds. They're saying, "Hey, you guys might be too big to fail." Here's the problem with that. Look, we all want to see the big guys get theirs, right? The big guy caution the little guys, story as old as time. However, allow us to remember in the financial markets exactly how the big guys, the Vanguards, the BlackRocks, got so big. They got so big because they served clients and offered services that people wanted. They signed up for voluntarily. Now, they're not operating within the confines of the financial insurance system. They are operating inside the confines of the law, and that's a big one. Because if there's something that you don't like about what the hedge funds are doing, what the asset managers are doing, what's going on in derivatives markets and swaps and all that kind of fun stuff, well, that's what the regulatory and legislative process is for. What they're talking about doing is forcing private companies to open their books and to allow regulators to tell them how to behave, even if they're in the confines of the current laws. I don't like what they're doing because they're expanding the definition without congressional oversight. Now, Congress is a circus right now, but Congress is the one that's supposed to make laws, not the regulatory bodies. That's just the way the document was written. It bothers me because this really is a power grab at many, many levels. And look, I don't like some of the policies of Vanguard and BlackRock's, ESG policies. To me, are an absolute sham because they, we're so good on, the environmental and the social and the governance. And then they turn around and you look at the lawsuits involving Boaz, Weinstein, and Sabre Capital and their closed-end funds and what they're doing to shareholder rights or trying to do there. Yeah, they don't jive. They like ESG when it suits their purposes, and they're the ones pointing fingers at other people. However, I don't want the regulators to jump into that. That's a job for the markets, for participants. That's, in case y'all didn't know, the markets, that's us. So anyway, this is really disturbing to me. Now, the banks, they're within the confines of the insurance. There should be somebody sitting on their head what they're doing with insured deposits. But if the risks of the financial system need to be addressed, then they should be addressed by legislators and by the markets themselves. You think back to long-term capital, I really do think, if you look at that, the New York Fed oversaw a meeting, but for the most part, it was bailed out by private parties. And that worked a lot better than government-sponsored, taxpayer-assisted bailouts. I think that we have to live with the fact that there's risk in the financial system. Always has been, always will be. We can't have random regulatory bodies assigning themselves new powers. So anyway, just something to chew on and think about. I'm aware that financial markets need to be regulated. I'm a fan of it. I've seen way too much in my years of people being taken advantage of. There needs to be laws. That doesn't mean that the regulators can go to private businesses. If they expand this to hedge funds, this is so problematic. They can expand that to private rules of capital, operating within the law. If we look at what they're doing to the banking industry, everybody's like, oh, the banking industry needs to be regulated. Well, it is. But again, you've got the Fed under the current proposals, they would have to hold 30% more equity here in the United States than the European banks are. It's a huge disadvantage. So got a lot of regulatory overreach going on out there. This is something I warned about back in March. We opened the door. Well, the regulators are coming through full force. And I don't think that it's the best possible outcome here. So anyway, commercial over. A Fed meeting, exactly as expected. The Federal Reserve did not do anything with interest rates, but the language was really hawkish. Jerome Powell, and I'm going to give him credit, he has tried at every turn to say, look, this is what we're doing. However, inflation back in the box is job one, and it's going to be really hard, and we may have to raise rates higher. And quit. He's done everything but say quit betting that markets are going to go higher because rates are going to go lower because rates aren't going lower. And he said it again. And they've talked about a soft landing, and he called that, it's not a foregone conclusion. It's a plausible outcome. It's not a plausible outcome. There's no depth. There's no way I can see a soft landing here. Now let's go back and take a look at something. Okay. First off, rates are going to be higher for longer. All right. Higher for longer now. We could be talking a very long time. If we don't get meaningful economic reduction in the form of a recession in 2024, which I think is going to happen, but you could be talking higher rates for a very long time because they're going to do just enough to end the recession. Economic reality is back. The days of zero interest rates are over. If we go back to zero interest rates, there has been a disaster. Okay. I'm talking about a 1930s style collapse of the economy. I'm talking about China invading Taiwan. I'm talking about Russia firing on a NATO nation. That's the only way we get back to ZIRP. If we go back to ZIRP, there's been a pandemic that is far more lethal than COVID was, that has devastating consequences for a huge portion of the population, devastating the economy. We're talking about a global war. We're talking about some sort of collapse in the system, if you were, from external events to get back to ZIRP. Rates are going to be higher than you're used to. If you're younger than me, you're not used to this, okay? Rates have been low and kept low your entire career. That's over. You're back in to what has been a major, massive policy shift. This is on a level with the policy shift of the Fed. Maybe it started in the internet crisis. More, I think the great financial crisis was where it got hammered home as policy. You've seen this major shift where the Fed intervenes every time something happens. Those days are over. ZIRP is gone. Okay. And you need to adjust that. Rates will be higher. They'll be higher for longer. This is it's massively bullish for fixed income. Fixed income is going to be volatile. Don't get me wrong. It's going to go up and down. I do favor here, if you want to play fixed income, heavily discounted closed-end funds with an activist doing something about closing the discount. That's necessary, okay, because you're going to need some discount closing and narrowing to offset what could be price weakness from increased bond volatility and negative moves in the interest rate markets. Remember, bonds are in a really nasty bear market at the moment. However, also remember that bear markets are born in bad markets. Then also, I think you need to, if you're going to be involved in fixed income, and you probably should be, individual securities, because then worst case you're getting your money back at maturity, right? And you can get 8 and 9% in like 5-year bonds, given the outlook for stock prices over the next 5 to 10 years using barometers like the excess yield on the CAPE ratio, which is just the earnings yield compared, I'm sorry, the 10-year treasury compared to the earnings yield of the CAPE. That's at very low levels, last seen since 2000 and 1969. I'll save you the lecture on those two things. Go check for yourself what happened after 1969 and 2000 for stocks. It wasn't pretty. That's just the cliff notes. Then you've got the average individual allocation to equities. The more money people put into the stock market, the more likely it is future returns are going to be terrible. It's scary how accurate that predictive indicator is. Somewhere between 2 and 3% is the number they've got for the next decade. Hard to build wealth at that rate. So you got to be thinking and doing differently. So higher for longer, get used to it. Let's talk about soft landings, because I've seen one soft landing in my entire career. It was in the 1990s, all right, coming out of the recession that cost Bush the presidency. Fed raised rates a little bit. I mean, lowered rates, then they raised them again coming out of that in 93. Let's talk about the difference between that 93 period and in the mid 90s. Banking industry was in full-on recovery mode. We were coming out of the great financial crisis. You had the last vestiges of it. The Drexel Burnham Lambert blow-up had been fully digested pretty much by the banking system, by the financial markets. If you look at bank credit standards, they had normalized, and banks were neither raising or lowering credit standards. Okay, they were at a certain level that had been set. They were accommodative, and loans were getting done. So you were not seeing big moves in the mood around credit. Conditions in the industry were just smooth sailing all forward, and you had consolidation really kicking into gear under a very pro merger, pro M&A administration. You can love Bill Clinton or hate Bill Clinton. And initially I hated Bill Clinton, but in the rearview mirror, guy was actually a pretty good president. A lot of good things happened on his watch. We'll leave the whole Monica Lewinsky thing out, but he was pretty good in the grand scheme of things. And he was very pro-bank and pro-bank merger. So it was a great environment for the banking industry. Trade with China was just starting to explode. We were hitting the up part of the hockey stick, and it exploded from there. Relations were maybe not wonderful, but they were good. The USSR was gone. That in Eastern Europe had imploded, had gone away. The pains of recombining the Germanys, for instance, and the move of former socialist republics into a more capitalist environment, and all the turmoil in Russia itself had pretty much been digested by the mid 1990s. And I don't want to say Russia was perfect, that there was a great love affair between the US and Russia, but it wasn't awful. There was no open hostility. We weren't, repositioning nuclear missiles or anything like that, like everybody's doing at the moment. You don't think that's going on, you're kidding yourself. Russia's been actively repositioning missiles for the better part of a year now. So let's just see what else is going on. Of course, you had, the Chilean government was, pulling off an economic miracle down there under admittedly, authoritarian leadership, but there was a lot of good things happening in Latin America on the economic front. The Pentium processor had just been invented, kind of revolutionizing computer speed, consistent with Moore's law. Speeds exploded. And this one's big, okay? This next one, the lithium-ion battery had just really been invented and perfected, making computing mobile for the first time in history. Imagine that, guys. All you youngsters out there. Before 1994, if you wanted to use a computer, the early 1990s, let's not be that precise. You had to have it attached to this big box thing that sat on your desk, and it, plugged into the wall and it plugged back in. It was complicated, and the internet was, it was a Department of Defense thing that was starting to have moderate usage outside of the world of government. But there was no Facebook, there was no hell, there wasn't even MySpace, but there was no Facebook, there was no Instagram, there was no TikTok. If you wanted to look up stock prices, you used the old S&P stock guide. I've got one around here somewhere. I got to find it. And it was a little book about this big, and you flipped through it and you found the stocks and you used a highlighter to go through. Yeah, it was not the easiest thing in the world if you weren't a broker with an access to a Quotron. And a Quotron wasn't exactly a high-tech system. So it was a whole different world when it came to computing. Before the Pentium processor made things a lot faster, and then came the laptop with the lithium-ion battery, and we all got mobile. And about a decade later, we got smartphones. None of this existed back then. We were in the early stages of that, and it was a massive contributor to economic growth. Inflation was very moderate. The Fed did raise rates at one point. They didn't lower them again in a meaningful fashion until the internet bubble collapsed. So it's not like they engineered a soft landing. There were all of these things contributing to economic growth. There was technology, there was China, there was mobility, there just all of these factors that were contributing to massive economic growth. And don't kid yourself, the Reagan Milken revolution of the 80s played a role here, because between the tax laws and Mike Milken's invention of the junk bond inspired takeover, a lot of fat had been cut out of corporate America. And corporations were running leaner than they ever had before. So you had all of these combination of things that just created this powerful economic tailwind. So it didn't matter what the hell the Fed did. They raised rates and they kept them stable. They didn't slash them back down. So there was, quote unquote, a soft landing. A recession ended in 92, basically, as Clinton came into office. Good timing for him. His misguided attempts to reframe the healthcare system had collapsed in and of themselves. Because, again, I think Clinton was a good president, but that was dumb. And the restrictions, if you go back and look at, they weren't brilliant. It was never going to pass. So all of that was out. You also had the European Union had been formed. And again, I don't care what you think about it and your opinion and whether it's good, bad, evil, the end of the world. It had a positive economic impact on the world. Same for NAFTA. And again, you can hate NAFTA, you can love NAFTA, and NAFTA's got good parts, it's got bad parts. And I'm probably more familiar with it than most because I was feet on the ground and owned a lot of Mexican and Canadian government bonds at the time because we were playing the currency swings. So we knew NAFTA pretty well. And there's good parts and bad parts, and it's still some good ramifications and some not so good. This piece of legislation that probably badly needs reworking, that whole trade relationship for modern times. But be that as it may, it was a huge plus for trade and the economy back then. So you get all these positive tailwinds. They don't exist today. Geopolitically, China hates us. Our trade relationship with them ain't great. We've got tariffs. They're selling treasury bonds in thankfully limited quantities so far. You've got Russia with the war in Ukraine. They don't like us. They threaten us. They have kind of moved some nukes around so they can use them tactically on the battlefield. We've spent the last 2 decades fighting the war in the Mideast against, very, technology is not involved to any huge degree on the part of our opposition. While we've been diddling and daddling in the Middle East, Russia and China have been expending a lot of money on hypersonic weapons and other advances. They kind of offset the effectiveness of some of our military forces. So we've fallen behind. In the 90s, there was only one superpower. Now there's at least two, and Russia would still like to be one. So the geopolitical situation has changed, and we ain't necessarily the leader anymore. So all of these former tailwinds, they're now headwinds. Now let's talk interest rates. Haven't seen an interest rate increase like that since the 1970s. Certainly didn't see it in the 1990s. Inflation, we're at rates not seen again since the 70s, early 80s. Certainly not in the 1990s, and inflation's not beaten yet, guys. So you've got all this stuff that existed in the 90s that doesn't exist today. A soft landing, yep, sorry, I don't see it as a likely event. Neither, by the way, there's James Skelter of Apollo. He's the co-president. He was speaking at the Global Credit Forum in London. He's skeptical. The higher costs of higher interest rates have not yet really filtered into the system, according to his comments, and I agree with his comments. In 2021, you still had loosey-goosey credit, right? Weak covenants. There was fairly good amount of high yield issuance and leveraged bond issuance with no covenants, no restrictions. It was damned easy to get a loan. So a lot of people took those loans and they haven't rolled over yet. That bill's still to be paid. And they were issued at very low rates. Remember, rates took off in 2022. So there's a lot of low rate paper out there in the high yield markets, in the leveraged lending markets, haven't matured yet. So the bill hasn't come due. So we're not on the verge of an economic collapse, but we do have a long, slow grind into a probable recession next year. Now, the headlines don't support that statement. The data supports it really well. And you got to learn to read the headlines, or you can just, let me read the headlines for you, because I'm going all the way down into the data. I want to go down. I'm going to look at consumer sales and say, that was great. It's really good. Consumer sales are up, man. The consumer's super strong. Well, wait a minute. Because revenues are up, unit sales are down. That means that's price inflation. And oh, by the way, consumer bank balances are declining and credit balances are going up. So maybe that headline's not that wonderful. So it is still a mixed bag headline-wise. Employment's not bad. The problem, if there's a problem in employment right now, there's union contracts. They just got massive increases, and probably deserved for the most part. Now you've got FedEx and UPS. That's a great job now. Honest to goodness. Now I've got one 20-year-old left home. Unfortunately, she might weigh 100 pounds if she's just had a double cheeseburger and is soaking wet wearing sweat clothes. Okay. So she's a little tiny thing. Working for UPS or FedEx, probably not an option with all the emptying the trucks and all that. If I had a 20-year-old son at home right now, I would drag them down to FedEx or UPS and get them signed up. That's going to be a really good job for a really long time. The unions want big contract advances. You can actually make six figures driving those trucks now. And that part of the economy is just going to continue to grow, right? E-commerce will continue to be a bigger part of our life. We're going to be, look, everything's going to be delivered, okay? It just gets stronger over time. We won't go down the whole rabbit hole of e-commerce and delivery services and what that means for the economy. Just that's going to be a great job. If I had a 20-year-old at home who didn't want to go to college, that'd be the discussion. Okay, get down there, get on the list, get one of those jobs, because you can spend your whole career there with a fantastic, high-paying job with great benefits. So anyway, again, the world's changing. The higher rates are not yet factored into the economy. We're going to have a recession sometime next year. The other thing that I look at, you look at the financial markets, and the headlines are great. Stocks are going up, earnings, blah, blah, blah. It's all, look, guys, 25 and a half times earnings for the S&P 500, over 40 times earnings for the NASDAQ. If I go back to 1994, the S&P 500 P was about 16. It fell below 15 in 1995, over 25 today for the S&P 500. Look, bull markets they're not born at 25 times earnings with a VIX under 15. That's not how this works. We have no fear. It's all complacency. Multiples are very high. Earnings are going to get compressed. We had a pretty good quarter. Okay. The second quarter, not great, but it didn't collapse. All right. That's true of 2000. That's true of 2008. 2 quarters before it all went ugly, had a pretty good quarter. So, you can't read too much into that. Now, banks. Let's talk banks specifically, because after all, that's what we're doing here. Banks are in a bear market. They've been in a bear market since 2022. We're not under the 200-day moving average, guys. We're under the 200-week moving average. So that's just only happened a few times before. Obviously, the great financial crisis, we got under the 200-week moving average. And there was a lot going on. There were banks failing. There was way too much leverage in the system. However, if you kind of watched all of that happen, and when banks got oversold and you looked at who was left, you say, oh, well, you never could have known that. Yeah, of course you could. Just by reading the reports, the call reports, you could kind of see the banks that were going to fail. You could literally see bank prices beginning to stabilize as we got into 2008. In 2009, you saw the bottom. You saw the indexes starting to move up. Stocks were still really cheap. There weren't as many banks left. Bearish sentiment was tremendous. And frankly, I'm not much of a technician, but I can look at a chart and say, oh my God, that's ridiculous. And buy the hell if you bought, and we did. We were a little slow. We really, really tiptoed in. I think Shore Bank shares, SHBI, a bank we're starting to get a little interested in these days. I haven't done anything with it, but we're getting interested. It was one of the first banks we bought, and I think it was in late 2009. So that was, we were under the 200-week moving average then. We got under the 200-week moving average in 2020 when the pandemic hit. Now, it seems to be politically expedient today to forget what the early days of the pandemic were like. And a lot of finger pointing. And I leave that to historians and, political types. Look, we didn't know. And trust me, I was in touch. I got a little bit of emphysema, so this concerned me. My son has asthma. Both my granddaughters flirt with asthma. It runs in the family. My sister is a severe asthmatic who, averages a couple of hospitalizations a year and she was very young. So we take respiratory infections seriously around here. So when we started hearing about it, we started talking to the epidemiologists, to the pulmonologists, to the cardiologists about what was going on and what the implications of COVID were. We didn't know. We didn't know how contagious it was. We did not know how fatal it was. And looking at what was going on at the time in Italy and across parts of Europe, as we didn't realize it at the time, and you didn't until we got much further along, the comorbidities, age, weight, existing pulmonary conditions were such overriding factors in the fatality rate. We did not know how lethal. We didn't know how infectious. We didn't know a lot. Markets seized up. As you recall, there were economic shutdowns that, for my money, went way too long. But again, historians have to evaluate some of this because I think a lot of people did the best they could with the information that they had. Some people used it as an excuse to seize political power and kept them in place way too long. Again, whole different discussion. We're not going down that rabbit hole any deeper than we have. In 2020, there was a very real possibility of complete economic collapse. It would have been massive, sustained unemployment. We had some pretty big unemployment spikes there, if you recall. Had that been sustained, then we'd have gotten into commercial real estate defaults, right? Businesses can't open. They can't collect cash. They can't pay their rent. Congress and the Fed could only support that for a very short period of time. Indeed, a lot of businesses don't exist. You go back and drive down the street in your town. A lot of the restaurants and bars and places that you see today, they were not there in 2019. The ones that were there in 2019 are gone. That's even true down here in Southwest Florida, where they were really quick to reopen. And again, for historians, we're not going there. And so we didn't suffer the severities of, say, bars in New York or parts of California or some other cities. Still, it was a lot of them failed. There's the workforce conditions that were created by that, they still exist. It's really hard to find hospitality employees and keep them these days. So there was a lot we didn't know. There could have been a commercial real estate collapse, which really would have taken out a huge portion of the banking industry. Bank stocks froze. And again, what I'm going to say, if you want to take it politically and argue it all day, there's no point. It doesn't solve anything because it's reality. Bank stocks froze until the vaccines were approved and there was light at the end of the tunnel. And then bank stocks started to recover. And for a brief shining moment in 2021, we even saw M&A activity pick up. That's only 2 times in the last 25 years that we've seen since the KRE was a thing. It's the only time that we've seen that happen. It's happened a few other times in history. Each and every time it's happened, it's been a massive buying opportunity. If you focused on healthy banks, do not try to bet on recoveries. You need healthy banks, adequate capital, really clean loan portfolios, management without a history of stupid loans. But the same things we've always focused on, guys. Clean loan, lots of capital, low valuations. That's worked every time. It's going to work this time. Not pain-free. Going to be headline risk. Let's touch on that in a second. We're going to get the headline risk. We're going to get into the other two now. The credit, the headlines would have you believe that nobody's paying their bills anymore and banks are just going to collapse right now. It is true that credit card defaults went up. That's primarily near prime and subprime. Banks don't lend to those folks anymore and haven't in a very, very long time. Think great financial crisis. The average bank borrower today has a really good job, a really high credit score, and is not the massive default risk. We're going to see an uptick in credit card defaults, right? Because there's going to be some layoffs. We've already seen it in technology. Unemployment claims will rise. Unemployment rate's going to go up. Auto loans, credit card loans, we're going to see some adverse credit in the banks over, I'm going to say, the next 6 to 12 months. It's going to be there. It's not going to be fatal. A, the leverage doesn't exist, and B, the borrower quality is a lot higher. Commercial and industrial, it's still that's loans to businesses, guys. That's non-real estate secured loans to businesses. 2 things going on here. One, it's going to be a moderate economic slowdown. It's not, based on the data now, going to be anything that looks like 2008. There would have to be some other external event. Again, Russia, China, energy, something awful has to happen for it to get 2008-ish. So the credit will get a little bit bad, but it's not going to be, the end of the world. It's like multifamily. I keep seeing all the fingers pointed about how terrible it is. Multifamily is not going to be that bad, guys. First off, this wave of supply they're telling you about, we had supply come online last year, and there was demand for it. Created in large part, by the way, by the spike in mortgage rates. You loved it at 3%. You can't buy it at 7%. Well, we're probably going to 8%. So, that created extra demand for multifamily. So we filled up what was built last year. A couple projects being completed. All that supply that was planned for next year and later this year, not going to happen. Nobody's lending. The real estate, the REITs aren't lending. The banks aren't lending for new multifamily projects. So none of that supply, it's all planned. Some of it's even permitted. It ain't funded, and it's not going to get funded until conditions improve dramatically. That's going to be a few years down the road. So if I was a multifamily developer right now, I'd not be happy. If I'm a banker with a bunch of multifamily loans I made over the last couple of years, I'm not sweating anything. Home Street, prime example, no delinquent loans as of the end of the quarter. And they're just not making any new loans. They're just going to wait. They've got a wait and see attitude, see how all this plays out. That's the right approach, by the way. So credit, little bumpy, going to be fine. Then the other thing is interest rates. Probably going to see, we could see another bump up in interest rates. There's no question about it. The Fed reserved the rate to raise rates. Higher for longer doesn't bother me. Remember something. If you look industry-wide, over 40% of all debt, securities held by the industry, mature in 5 years or less. I think it's over half. I'll have to go back and check those numbers, but it's between 40 and 50%. And so that's all those marks, boom, recovered in 5 years or less. If you get a huge shift up in rates and you've got 5 year or less maturities, it's not going to be a wild swing. Those few that loaded the boat on 30-year treasuries, they got a problem. If they don't have a lot of capital, they're going to be in trouble. Now, we saw some banks this quarter, and it's the smart move. If you've got a lot of capital, you can take the hit, right? Because you got to write the loss against your capital once you book it. If you've got an equity to assets ratio of 15, 20 or higher, you can sell your securities, take the hit, get rid of those very low rates and reinvest them at much higher rates. You can take a 1.5% bond, sell it right now, even though the market yield on that was 3, you can reinvest it at 5.25 in a short-term treasury. So there's a yield pickup there if you can take the capital hit, which is why capital is so important in any market, but especially right now. So there may be some banks that struggle with that. None of our banks are going to struggle with that. It's just not a problem for us. Our banks that have long-term securities are former thrifts. Lots of long-term securities are former thrifts. The former thrifts all did conversions. They have lots of capital. There are some banks with lots of mortgage-backed securities. Just going to have to ride it out, guys, because there's no refinancing wave coming to save you. On the same token, I think they've been hit about as hard as they're going to get hit, as it would take something dramatic to bring rates meaningfully lower. It would take something dramatic to take them a lot higher. We may go a little higher and stay there for a very long time, but that's all marked into the treasury market and particularly the mortgage-backed security market right now. They've fallen. They're going to stay there. They're going to be there for a long time, which, by the way, is why agency REITs right now are just a massive buying opportunity. I'm talking Annaly. I'm talking Redwood Trust. They have some credit risk, but nothing that would keep you awake at night. Same with Arbor, ABR, and then my favorite, AGNC. And these things are all yielding 10, 11, 12, 13, 14%. And because the mortgage market has fallen and it's going that way, and two of the biggest buyers, banks and the Fed, are out of the market, pricing's really good. Spreads are at levels over 10 years treasuries we haven't seen in a very long time. So just a thought, throwing it out there, just on the off chance that you're interested in yield-oriented investing. This is a pretty good opportunity for that stuff. Again, like banks, it'll probably be bumpy. They're not going to collapse. They're not going to go away. If you can collect those dividends and make it through to the other side, you're going to have really fantastic returns that compare incredibly well to what I think the stock market's going to do. So credit, bumpy, interest rates, problems for banks without a lot of capital if they go a lot higher. I don't think they'll go a lot higher. Regulatory environment, if the big banks are going to struggle with this. Hopefully we stay at the 100 billion and above level. They'll try to come lower. It's what they do. We'll see. It's an election year coming up. That may slow some of this down. Really not a fan of what's going on with the trying to expand the too big to fail. If you take that logically, it's the last thing I'll say on it. If I take that logically and I say, okay, all of these mutual fund companies and asset managers, they're too big to fail. These insurance companies, well, we're going to make them too big to fail too. They've had nothing to do with any financial crisis ever, but we're going to put these P&C companies in there too. And hey, you know what? If Amazon failed, that'd be a real problem. So let's put them in there too, make them open their books and their policies and everything that they do on a day-to-day basis. Let's make them subject to extra regulatory control and cap their returns. Can't happen. I've never seen a government give back power or fail to at least attempt to expand it. So can happen, probably will happen, which is why closed door meetings to discuss expanding that don't sit well with my libertarian soul. But that is, I promise, the absolute last commercial on that today. Credit, securities, regulatory risk, all something that we're going to have to deal with, going to create bumpy. However, we are at levels where we're in the past, in the rare times that this has happened, if you bought banks with high capital ratios, great credit portfolios, sound balance sheets with lots, and this is the key, lots of excess capital, you've made an enormous amount of money, and your sleep tight factor was through the roof because financially speaking, because of that solid loan portfolio and lots of capital, you were taking about that much real long-term financial risk. So anyway, guys, I'm Tim Melvin. That's our update for today, the 22nd of September, 2023. I got to run. Few things left to do today. Got beach plans with a certain granddaughter this weekend. Just, lots of good family oriented stuff going on down here. I hope you get out. You have a fantastic weekend into next week. Selective. Capital matters. Price matters. The lower that price to combination, price to tangible book with high capital, it's going to be really hard not to make money if you're a patient, aggressive investor. Anyway, guys, I'm Tim Melvin. Have a great weekend. Go Orioles. We lost to Cleveland last night. Really important 3-day series with the Cleveland Guardians for the weekend. We'll see how it plays out. This is a great time. Big college football weekend, big Major League Baseball weekend, and just got a bunch of books loaded down on the Kindle. So I should have a fantastic weekend, including some beach time with a granddaughter. So hard to go wrong with that. Have a great weekend, everybody. Price to book, decent credit, lots of capital. It'll make you a lot of money over the next several years. Bye.